Hey guys, what is up? It's Arthur here. Welcome to this video in which we're going to talk about Micron technology as suggested by one of you under a previous video. So thank you very much for that. Fantastic suggestion. Before we dive into that, I want to let you know that I launched my website, sort of relaunched it, and it's arturnagy.com, arturnagy.com. If you want to check it out, go ahead. There is an email subscription box on the very bottom of it where you could subscribe, give your email, and I'm planning to launch a course to offer more people firmer grasp on this topic, and I plan to start selling it from just $1 and add $1 every time someone buys it. So if you want to be part of that and get like a lot of quality content in this topic, just drop in your email and I will send you a notification or like an email once it is out, so we're not dependent on algorithms, and it's just, I think, a very fun win-win situation for everyone. If you're interested in that, drop your email and I got you covered. Other than that, let's get into Micron technology. Let's see what they do. Micron technology engages in the provision of innovative memory and storage solutions. Computer network business unit, mobile business unit, embedded business unit, storage business unit, memory products, solutions sold into client, cloud, server, enterprise, graphics, and networking markets. So my question right off the bat, established in 1978. Okay, so mobile, automotive, industrial, consumer markets. Are we making chips, or is it strictly memory, like RAM, memory, and storage? Interesting. It's a good suggestion, this company, because I don't think I've ever heard of it. Even if I heard, I don't remember it. So I had to look up their website right off. It starts with a huge investment in the US, so that's something to keep in mind, that they are building a factory. Might mean more debt that is gonna have a return later in the future. So we have Micron samples first to power AI platforms. Okay, mobile AI, blah blah blah. Chips, data center, client PC, automotive, mobile, AI data center. So there is some AI play in this, which is interesting. However, what I was surprised to see, we go out, this is our trusty dashboard, market cap of $136 billion, roughly a third of Coca-Cola and Johnson & Johnson that we just looked at in the previous video. And about what if NVIDIA is 3 trillion, around there, 10% of that would be 300, so 3% of NVIDIA's size, roughly. A lot of green numbers across the board. A very nice increase in tendency, but we don't care about this. We want to know what the numbers, what the fundamentals tell us. And so stock's been up. But what I was curious about is that if we go out 5 years, I don't know where the AI craze and boom was. Definitely not mid 2024. I think it was later than that, but I just can't see it. Like, was this company just left out of the whole AI thing, or like, where is it? Because like the biggest increase you see is just a double, like going from $50 to $100 a stock. I don't know what's up with this, but they seem like they got left out, or they really just do make memory and data storage, which is not, I think, is not the exact kind of chip that you want to make computational powers, or I think they are not the same. I think they use like CPUs and other more, like a different version of chips to do the computationally heavy tasks. All right, so then let's see what we can see here. Probably not much here. Let's start here. Enterprise value is higher than market cap, which is market cap plus debt and minus cash, which means that because this is a higher number than market cap, there's going to be more debt in this business than cash. So how do our profit margins look like? Gross profit from 5 years ago, 29.5% up to 30, almost 35% in the trailing 12 months. So that is good. That is a very nice increase. I think it's still far away from something like an Nvidia. Net margin wise, also up from 10.11% almost to 15%. This is also very, very nice to see. Seems like a reasonable PE, but I wouldn't get too hyped up for this because it doesn't look like an AI chip maker, or like strictly like the computational chip maker. If it's really for memory storage and data storage, it's a little bit different. So I wouldn't really think or get like super excited because this is a low number for like a chip manufacturer. So you and I would have to do more research on that. Past PE has been higher, so that's interesting. Okay, is there any dividends? Oh yeah, this is an atrocious price to free cash flow. That's because the free cash flow is going to be negative. So 5-year average pass, we're not making money. We're going to look into that. Dividend amount 0.12, 0.48, so quarterly dividends like most US companies. Dividend yield of 0.39%, not much basically, but it is costing $500 million worth of free cash flow to the company, and the trailing 12 months they made only 600 million, so that's like 85% of their free cash flow, which you can see here also, which means they're not buying back any shares most likely. So I'm not sure that I like that at first sight. Less than $1 billion worth of acquisitions, not a lot. So let's see what we can find here. We have a handy list on the right hand side, 10 items that we're gonna go through. I'm gonna explain them as we go. And for that, we use MarketWatch. It's publicly available. You go to the financials. These are the 3 statements that companies issue every quarter, and it's aggregated in years, but you can also go quarterly if you want more recent data. All right, so first things first, revenue. We want revenue to increase, and this is a check mark because we went from 21.4 billion up to 25.1 billion, which is a 17% increase. It's been up, it's been down, so it's not that steady, but it is growing, which we'd like to see. If you work your way down the costs, we're looking for net income, and we also want this to increase. This is going to be an X this time because we went from 2.7 billion down to only 0.8 billion. It's essentially $800 million. Again, it has been going up, then we hit a massive loss, and we're just climbing back to practically almost zero. You gotta find out why this was and what happened. Let's see if we can find it. Pre-tax income still, EBIT still negative. Oh, here, gross income. Okay. I mean, sales revenue were just that much lower, I guess. And you had all the same costs on top of it, as what I'm guessing. Yeah, I don't know what happened in this year. This is something to look into and understand why this happened. Is this something that was just a one-time hiccup, or is this something that could happen again? How much you can consider, or should you consider these year in your calculation? Because if it is an outlier event, some sort of, you might be able to take the first 3 years and the last one if this is so off. But if this is something that can happen and was just a bad business year, I would consider it and use those. Now, what we can do with the net income is that we can make out the average of these 5 years, which is 2.44 billion. Now that we have this, we can take the market cap of 136 billion, divide the two, And then you get a number which should be below 20, but this time it's above 55. Now this gives you the amount of years it would take for your purchase in this company to make its money back. It's price to earnings. You can understand this in two ways. Price could be the market cap, the whole price for the whole company if you want to buy that. And earnings is the net income here, or you can just divide by the share amount, in which case it becomes price to earnings, price of one share to the earnings per share. But I recommend you keep it market cap and net income for the whole company, because you are becoming a business owner if you decide to buy a share. So just think about buying the whole company, because that is the weight of the situation, really. All right, now that you have your 5-year PE, one thing that I love to do, and I recommend doing, is that looking into competitors. TradingView has company profiles. You have these breadcrumbs on the top. You go to the most concrete segment, which is semiconductors. You're going to find a ton of competitors. In this case, there's also NVIDIA. You have a PE column for this. I grab all these, put them in an increasing order, take the middle one. That's what I'm going to say is going to be the PE ratio for the industry. And then we are going to check how those two relate to each other. And in this case, that's an X, because the industry median PE is 29.28, which is lower than Micron Technology's 55, which means that Micron Technology is a lot more expensive than what is usually is true for this industry. So that's an X. Next, I want to look at what is called a return on invested capital. Basically, if you put $1 into this business, either through loans or money into the company, how many cents they can earn on it. There are different ways to calculate this. This is not an official, there's no agreed upon formula. Different websites are going to show you different values. Mine returns a 5.7%, which is below the market average of 9 to 10%. So this is another X. If you want to check this number on MarketWatch, you can go to the profile and they have it here, return on invested capital. In this case, this is even lower at 1.34%, which is just bad. I mean, at least they're not losing money on the money that gets put into this business, but like the market average is 9 to 10% again. Sometimes my return on invested capital numbers are lower than what's here. So really there are different ways to calculate this, and there's no generally agreed upon ones. Next, we're going to look at my favorite, which is the number of shares outstanding. This is going to be an income statement on the bottom. You work your way down to the money that you have to split by the number of shares. I use diluted shares outstanding. Basically, you can use either basic or diluted. I use diluted because that's more conservative. And we want this number to be going down. And that's a check mark, because we are down from 1.13 billion down to 1.12 billion. We see that it has been higher, it has been lower, and then went up again. So there are some, let's see if the difference is not always the same. So it might happen that some people are exercising their options or converting their, bonds to shares, but the difference between the number of shares isn't that big, so it's not going to affect much. But what we can see is that shares have been going up and then down and then again, so I don't know if they are issuing some shares. The movement, the change isn't that drastic, and overall over 5 years we are down 0.88%. So I would just, technically it's a check mark because it is going down, but we could just say that it's stagnating. It isn't going anywhere, but at least it's not a huge increase. So that's a check mark for now. I'm not super impressed by this. I'm not impressed at all. So we're gonna see what happens in the future. What are their plans? You can look into whether they have share repurchase programs planned, or if they have done so in the past, because they are funded. They were funded in 1978, I believe. Yes, so plenty of time to do something like that if they think their share price is nice. Because if it is something that they also like, then they could do a share buyback, because they also want to get a good deal on buying their own shares. If they are not doing it and instead issuing more shares, that could mean that it's overpriced. That's just another proxy of getting an insight of the value. All right, next up, number 7, I believe. Yes, we want to look at the rate at which long-term liabilities have grown compared to the revenue growth, which you can see on the first card is 17.12% over 5 years. And we're going to go to the balance sheet to see liabilities, which are going to be basically on the balance sheet. You have total assets. You have the asset side, which is what you have, and then you have liabilities and shareholder equity, which is how you finance it, right? This is what you have, how you can afford that. It's that simple. And the two sides have to equal each other. All right, so for long-term liabilities, the trick is you have total liabilities and you have total current liabilities. Current liabilities are what is meant to like execute or like be due in 1 year, and everything that's long-term is beyond 1 year. Now you don't have a total long-term liabilities section. So what you do, you take total liabilities like this, and then you deduct the total current liabilities, so you're left with the total long-term liabilities. You do this for all 5 columns, and then check what was the percentage increase by dividing the last number with the first one. If you do that, you're gonna get that it increased 87%, while its revenues only grew 17%, which is an X, because they took on more debt than they were able to grow their own business, which is not a good sign, because you would want to grow your revenue first without that, and second, even if you use that in a faster way, then you take on debt. However, we just saw on their website that they also have like a $2 billion investment making a manufacturing and R&D facility, so they might have to taken on loans to get this done, which could explain, it doesn't mean it is the case, but it could explain why their debt has risen so quickly. And this is something in which case you might get a return on this debt later on. Okay, so it's not a one-to-one comparison over the 5 years, because debt can have a longer time horizon of when it starts making revenue. Okay, just keep that in mind. You would have to see if this debt is included in the past like 5 years, and like what is the relation, and when can you expect this to make money. All right, and then next up gonna be number 8. We want to take a look at free cash flow, which is used for 5 amazing things that a company can do. We just looked at how much dividend they are paying, which was 85% of their free cash flow. So only 15% is left for doing everything else. What they can do with free cash flow is pay dividends, buy back shares, which we also saw they don't really do, reinvest in the business, buy other companies, and to pay down debt. So only 15% left for the last 3, which might put them in a bad position financially, in a tight space, and we're gonna check that. But first, what I wanted to show you is that dividends, I have this dividend compound annual growth rate to just tell how fast these dividends are growing. Currently it says dividing by 0, which happens because if we go to, I will show it to you here because it's just better formatted. You can go to cash flows, because again, from the cash flows is what they pay out the dividends. And in financing activities, there is going to be cash dividends paid total. As you can see, there was probably no dividend in 2020 and 2021, so you can't compare the increase of these 5 years, the growth rate, but you can just hit up a compound annual growth rate calculator, put in year number 3, year number 5, and then there was 2 increases from 3 to 4 and 4 to 5, and then it's just going to say to you that the dividend has been growing at a 5.49% rate, which is above long-term inflation of around 2.5%. So dividends are growing faster than inflation, which is good because inflation will not eat your dividend amounts away, but it isn't a huge company, so they might want to focus more on actually growing the company than paying dividends, especially in the current era where there is a lot of potential with like AI and automation and all that. So this is something also to look into and check. All right, back to the topic. Let's calculate free cash flow. Again, we're going to be in the cash flow tab, and the formula is really simple. You're just going to take net operating cash flow and you're going to add the negative capital expenditures number. So basically, plussing a minus number is minus. And you do this for all 5 years. And then you again compare the last year to the first to see how it has increased. On MarketWatch, you can find it on the bottom. And this is not a lot of free cash flow that we have, but it's also important to see, and something I would look into is what these capital expenditures were for. I don't know if probably they explained this in their 10K or somewhere on how they improved the business, because this is how much they earn from operations, and they almost invest the whole thing back into buying some things for the company. So there could be cash flow, but they are just reinvesting a lot, it looks like. So you gotta look into that. And you can also see that it's a lot of fixed assets. So probably like plant, equipment, something like that could be the case as far as I'm seeing it. So free cash flow, not much is left. Also huge negative year. Growth, we can take a look at the growth. Growth has been going from 83 million to 121 million, which is not a lot. Comparing the numbers that they have been pulling in terms of revenue and net income. So the growth is there, so it's a check mark. It's 45% increase over 5 years. However, the average is negative, which makes it not really possible to calculate with. So you either substitute a number, but I just use this number because this is what they managed to produce in the past 5 years. What I would do next is take that long-term liability number that we looked at and you recalculate it, and you would take that number and divide it by this average free cash flow, which would give you a number of years of how much time it would take to pay down all those debt. Now, if you go ahead and do that, it's not really valid. It's an X because with a negative free cash flow, you cannot really pay down debt. So it's just something we cannot interpret. And then you can also use that free cash flow number, if it's positive, to divide the market cap with. And that would give you, again, a number of years, which is an X here because we cannot interpret this. This would give you how many years it takes in terms of free cash flow to make your money back if you were to buy this whole company. So this leaves Micron Technology with a 3 out of 10 score. And yeah, the problems I see is that we don't have any free cash flow because a lot of the operational cash flow is spent on capital expenditures. This is not a problem, but you have to look into this and understand when can you expect a return on this, what they are using this for, is that a good investment, and probably that would be something to look at. Also, if you take a look at here, free cash flow in the trailing 12 months and net income in the trailing 12 months and also 5 years is very far apart, which some investors don't like. This could be a problem. I'm not exactly sure, but net income is easier to manipulate. So even though this looks better, free cash flow is harder to manipulate and is much lower than this. So this is something to pay attention to and maybe do some research on. I also have to do some research on this of like what could be the cause and effect of these two, net income and free cash flow, being so far apart. So this is something to keep in mind. This is not a positive sign as far as I know. And I take we cannot make a discounted cash flow model because the average free cash flow that we have is negative, and yeah, we can't, I think. Though I could sort of hack it in the future and assume that the negative numbers will grow, but whatever. Because we could take the compound annual growth rate and just like start increasing this negative number. But really, there isn't much here. What we can do is try maybe use the trailing 12 months just as a hypothesis to see what's happening there. Or maybe let's just use the latest financial year because that's closer to the average. And then we're gonna take this compound annual growth rate for the first 5 years, half of that for the second half, and then we're gonna bring those values back to present day. Let's see, we're gonna add the cash and short-term investments, deduct the debt, and yeah, we don't have a positive equity value, so we can't proceed with that one because the shares are not worth much. So in this case, you would say that the shares, the value of the company or the share doesn't come from the free cash flow it generates, because it does not. The 5-year average is negative. It is very minimal that they generate. So there are other valuation methods. Discounted free cash flow is not really applicable here. Discounted cash flow. So that's for this part. And there is a new part that I was really excited to tell you about. I knew I wanted to tell something more in the intro section, but I just made this compare section, which I think would be very interesting, because when I saw Micron Technology was into semiconductors, I think it's more into RAMs and data storage. But if you just pull up NVIDIA here, because I made this able to run like two data gathering side by side, we can see that actually NVIDIA is pulling almost double 2.5 times the gross profit margins that Micron is doing, and then the profit margins for NVIDIA is just miles better. It's 4 times as high. And the PE ratio in the past 12 months, it's what, 1.5x. So NVIDIA is more expensive, but we can also see for the 10x part, the 5-year revenue growth is there for NVIDIA. So it's much easier to justify the PE ratio being just 1.5 times higher. But the growth NVIDIA has been producing is phenomenal compared to Micron. Also, just looking at the 10x, NVIDIA is a 7 out of 10 compared to Micron's 3 out of 10. NVIDIA has better revenue growth, although it's a much larger company. Net income growth is also insane there. Price to earnings in the past 5 years is higher, but it's still high for Micron. But for Micron, I have a harder time justifying it. They are in the same industry, both are higher than the median. So that would be an X for both. Return on invested capital, again, 5.7 for Micron. This is below the industry, not the industry, like the market average. While as for NVIDIA, it's super high. Market average is 9-10%. This could mean because they have a moat, what you would call the moat. They have their own like AI like development ecosystem, as far as I know, and it's working very well, and they do have some competitive advantage there, which keeps users using their systems, as far as I gathered. And companies with more sticking power have higher return on invested capitals because it's just easier to sell new things and keep people in their ecosystem. So that is very nice. They also buy back more shares, and compared to debt levels, debt level increases and revenue increases, Nvidia just produces a much better difference in that term. Free cash flow growth is there. They have a super easy position. They could just write a check and call it a day in terms of all their debt. And then price of free cash flow is high, but this is for the 5 years. You would want to look at the trailing 12 months, which might be more accurate, but would have more noise in it. Do we have that? Price to free cash flow. Yeah, it's around the same as the PE ratio, but you can see that Nvidia keeps up with the net income. I think that would be closer. Yeah, that is closer, and there is a lot bigger discrepancy for Micron. So I think that is it. I would still go with Nvidia over Micron. I think Nvidia is closer and has more potential, even though it's a huge company. It might be the biggest now. So that's my take on this. I hope it was helpful. I really wanted to show off this compare feature that I just made. Let me know how you liked it, and don't forget to visit my website, arturnaut.com. Drop in your email address, and I will let you know when the course launches, so you can get in for a very fair price and make that the best investment of your life. And I hope to provide you value that way as well. Let me know how you liked it. I hope it was worth your time. Thank you for checking it out, and I hope to see you in another video. Let me know in the comments which video that will be. Thank you very much, and see you guys. Bye-bye.